During the early months of 1997, the economies of Northeast and Southeast Asia were flourishing. Reports from various nations, including Thailand and South Korea, praised the remarkable economic potential of these regions. However, on July 4th of that year, the situation took a sharp turn for the worse, leading to a collapse of unprecedented magnitude. Thousands of businesses went bankrupt, millions lost their jobs, and even the billionaires who had built these economies suffered severe losses. One of the countries most affected by the crisis was Indonesia, Southeast Asia's largest nation, which experienced a catastrophic financial collapse. Over the next 2 decades, the memory of this crisis gradually faded away, and many people have forgotten about the devastating impact it had on Indonesia. However, revisiting the lessons learned from this event, as well as its ongoing impact on the country, has become critical for the future of Indonesia. Let us understand everything from the very beginning. In the years leading up to the crisis, Indonesia experienced rapid economic growth, averaging around 8% annually from 1987 to 1996. This growth was fueled by a confluence of factors, including a young and growing population, abundant natural resources, and an increasing demand for manufactured goods from developed countries. The Indonesian government, under President Suharto's rule, implemented policies that prioritized economic development and modernization. Infrastructure projects such as the construction of roads, ports, and power plants were seen as essential for attracting foreign investment and fostering economic growth. To finance these ambitious projects, the Indonesian government, as well as private corporations, sought loans from foreign banks. This heavy borrowing was encouraged by a favorable global economic environment, characterized by low interest rates and abundant liquidity. Financial liberalization policies, which eased restrictions on capital flows, also contributed to the growing ability of foreign credit. As a result, Indonesia's external debt ballooned from $58 billion in 1990 to $133 billion by the end of 1996. The debt-to-GDP ratio skyrocketed from 25% in 1990 to more than 60% by the end of 1996. The influx of foreign capital led to the appreciation of the Indonesian rupiah, making imports cheaper and increasing the demand for foreign goods. This, in turn, led to a widening current account deficit, reaching a peak of 3.5% of GDP in 1996. The Indonesian economy became increasingly dependent on short-term foreign debt, exposing it to the risk of sudden capital outflows. The rapid accumulation of debt was not unique to Indonesia. Other Southeast Asian countries such as Thailand, Malaysia, and South Korea also experienced similar debt-driven growth during this period. However, beneath the veneer of prosperity, there were growing concerns about the sustainability of this debt-fueled growth model. One of the key issues was the allocation of borrowed funds. While some investments were productive and contributed to economic growth, many others were directed towards speculative activities in the property and stock markets. This led to the formation of asset bubbles, with property prices in major cities like Jakarta and Surabaya rising by more than 200% between 1990 and 1996. The booming stock market also attracted a significant inflow of foreign portfolio investment, further increasing Indonesia's reliance on foreign capital. Another concern was the growing mismatch between the maturity and currency composition of Indonesia's assets and liabilities. Many Indonesian companies and banks borrowed short-term funds in foreign currencies, such as US dollars or Japanese yen, to finance long-term investments in domestic assets, denominated in Indonesian rupiah. This created a currency and maturity mismatch, making the Indonesian financial system vulnerable to sudden changes in exchange rates or interest rates. Moreover, the financial sector in Indonesia was characterized by weak regulation, lack of transparency, and widespread corruption. Crony capitalism, whereby well-connected individuals and companies enjoyed preferential access to credit and other resources, was rampant under Suharto's regime. Many of the large conglomerates that dominated the Indonesian economy were controlled by Suharto's family members or close associates, creating a web of patronage and rent-seeking that undermined the efficient allocation of resources. The first domino fell in July 1997 when Thailand, another Southeast Asian economic powerhouse, was forced to abandon its currency pegged to the US dollar. This sent shockwaves through the region as investors became wary of the sustainability of other fixed exchange rate regimes. In August 1997, Indonesia came under speculative attack, with investors rapidly withdrawing their funds and converting them into dollars. The Indonesian government tried to defend the rupiah by raising interest rates and spending its foreign exchange reserves, but to no avail. By November 1997, the rupiah had lost more than 60% of its value. As the rupiah plummeted, Indonesia's foreign debt burden surged. Dollar-dominated debt became increasingly expensive to service, and many Indonesian companies defaulted on their loans. Banks faced a sharp increase in non-performing loans, leading to a full-blown banking crisis. The Indonesian government was forced to intervene, closing 16 insolvent banks in November 1997. This exacerbated the crisis as panic spread throughout the financial system. In January 1998, the government requested assistance from the International Monetary Fund, which provided a $43 billion bailout package, conditional on the implementation of fiscal and monetary reforms. However, the crisis deepened as the IMF's austerity measures further contracted the economy. Indonesia's GDP contracted by 13.1% in 1998, with inflation reaching 58%. Unemployment soared and poverty rates increased dramatically, with an estimated 50 million people pushed into poverty by the crisis. The social and political consequences were immense, leading to widespread protests and ultimately the fall of President Suharto in May 1998. The 1997 Asian financial crisis taught Indonesia and the world several valuable lessons. First, it highlighted the dangers of excessive short-term foreign debt and the risks associated with fixed exchange rate regimes. In the years following the crisis, Indonesia shifted to a more flexible exchange rate system and implemented policies to manage its foreign debt more prudently. Second, the crisis exposed the weaknesses of Indonesia's financial sector, including poor regulation, lack of transparency, and weak corporate governance. Post-crisis reforms focused on strengthening the financial sector, including the establishment of an independent central bank, improved bank supervision, and the implementation of international accounting standards. Lastly, the social and political fallout of the crisis underscored the importance of inclusive growth and social protection policies. Indonesia has since invested in poverty alleviation and social safety net programs to reduce vulnerability to future economic shocks. The 1997 Asian financial crisis left an indelible mark on Indonesia, shaping the country's economic landscape and influencing its policies and development trajectory for decades to come. While Indonesia has made significant strides in addressing the root causes of the crisis, the impact of events in 1997 is still felt in various aspects of today's Indonesia. The crisis highlighted the importance of a stable and well-regulated financial system. As a result, Indonesia implemented a series of reforms aimed at strengthening its financial sector, including the establishment of an independent central bank, improved bank supervision, and the implementation of international accounting standards. These reforms have contributed to the resilience of the Indonesian economy, enabling it to better weather external shocks such as the 2008 global financial crisis and the ongoing COVID-19 pandemic. The social and political fallout from the crisis underscored the need for inclusive growth and robust social protection policies. Indonesia has since invested in poverty alleviation and social safety net programs to reduce vulnerability to future economic shocks. Efforts have been made to expand access to education, healthcare, and basic services, as well as to promote more equitable income distribution. While progress has been made, challenges remain in addressing the country's high levels of income inequality and persistent pockets of poverty. The crisis played a crucial role in the political transformation of Indonesia. The economic turmoil and social unrest that accompanied the crisis led to the fall of President Suharto's authoritarian regime in May 1998, paving the way for democratic reforms. Indonesia has since transitioned to a more democratic and decentralized political system, with greater political participation, freedom of speech, and respect for human rights. However, corruption remains a significant issue and further efforts are needed to strengthen governance and the rule of law. Our journey through the tragic tale of Indonesia's debt crisis has led us to a greater understanding of the complexities and vulnerabilities of modern economies. The 1997 Asian financial crisis was a turning point in Indonesia's economic history, revealing the perils of unmanaged debt and the importance of sound microeconomic policies. Today, Indonesia has emerged as a more resilient and diversified economy, having learned the painful lessons of its past. While the ghosts of 1997 continue to haunt the memories of those who lived through the crisis, they also serve as a stark reminder of the need for vigilance and preparedness in an increasingly interconnected global economy.